Okay, this morning I'm going to go over the organ transplant carve-out. For some of you who may not know, Rush Jays is the vice president of this product. Wonderful gentleman, my boss. I won by default to be here. He had a back injury and couldn't fly. So us girls were on the phone, yes, gambling and shopping. We were so excited. So here we are. Okay, I'm going to go over some just quick facts in regards to organ transplants. It is true we have over 1,000 groups with this product. We are the largest organ transplant product in the U.S. Sorry, Optum, but it's true. Okay, transplants are often lasered. Again, true. The stop-loss world today, if they have a known risk, they are going to carve out that transplant. They don't want to, but they have to. They have to keep reasonable rates. Makes sense for them. The majority of your stop-loss carriers should give you a discount for having this product. Anywhere from 2 to 10% they should offer you. If they don't, let us know. We can give them a call. Carving out your organ transplant makes financial sense. You're insuring it in another area. It's a no-brainer. Carving out also addresses the severity and frequency of the risk. Transplants have doubled in the past 15 years, and this is going to continue to go up. It's a fully insured first dollar product. No deductibles, no coinsurance to the employer or employee. We do offer significant benefit upgrades. Your plan document in a self-funded groups plan is normally 1 to 2 paragraphs devoted to transplants. Ours is 24 pages long of upgrade benefits. We offer liberal underwriting. We are not looking at 100 trigger codes when we're underwriting to this, and I'll get to that in a few slides. And it does offer that competitive differential for you. You have an opportunity to offer your client a risk transfer. Not only do you get the risk transfer, you get our case management, and you also get our network. We own our own network. Here you will see the average waiting times per transplant. Look at those times. Focus on kidney. That's a 3-year wait. Imagine what 3 years can do to this group's stop-loss while they're waiting for this transplant. It could impose a financial ruin for that group. Here you will see the average billed charges per transplant type. These numbers are from minimums. We just didn't make them up. You'll see in the blue, that was in 2000. In the red is now 2011. It's important that you understand this slide, because far too often transplants are thought of as just a case rate. That is just not true. You must include donor charges, hospital charges, drugs to the complete episode of care, and again, look at it as a year or longer. Here you will see the number of transplants per year. You will notice bone marrow and kidney are the big guys. Bone marrow is rapidly increasing due to medical technology. Kidney is coming right up behind it. Why? Because of the donor pool has increased. Family members are now donating their organs, live organ donors. Also, you can walk into the license branch, sign the back of your license, donate your organs. Happens all the time. The important number to look at the bottom is the waiting list of candidates. And a new person goes on that list every 18 minutes. Keep in mind, too, there are 3 times this number that do work up significant charges, but yet they never do get transplanted. And again, your stop-loss carrier is going to look at them as a known risk and will either laser or rate up. And we like this slide because this will show you the probability by group size. You'll notice we have the number of employees from 100 to 2,000, and then the probability of a transplant in the first year versus the 3rd year versus the 5th year. We like this because we do have small groups that will come to us and say, we only have 200 employees. We're a small group. We've never had a transplant. And we'll tell them, if that's the case, you need to ignore that 1st year and the 3rd year and focus on that 5th year because you are due. You are now looking at a 50-50 chance of having that transplant. Look at the number of employees. The higher your number of employees go up, the higher your chances are. You have more people out there that can hit that transplant. Okay, this will give you some of the policy features and benefits that we do offer. We offer 1 million, 2 million, and an unlimited lifetime maximum. I will tell you that unlimited is usually not necessary. Healthcare reform, I know everybody is taking their stop-loss because you have to. Healthcare reform does not affect us. We're hoping it never does, but it does not affect us. Usually 2 million is significant enough for you. We've never had a transplant go over $2 million in the 9 years that we've been selling this product. We offer that standard benefit period. Evaluation is when we start through 365 days. So when that physician says to the participant, you need an evaluation, boom, our clock will start ticking for this patient. We do cover all major transplant types, all solid organs. The only thing you do not see on there is cornea. The reason we do not cover cornea, high frequency, low cost. Really isn't necessary to add it to these charges to make your rates go up. The plan does pay 100% of transplant-related expenses when in network. If it's out of network, it is subject to our benefit that we cover for out-of-network charges. We do offer a general travel benefit allowance, $10,000. We added that because we wanted to mitigate the cost for the patient. We also cover NCI phase trials 3 and 4 for adults and all pediatrics. Retransplants happen, they are covered. The only difference is if it's within 90-day periods, it's just a different benefit period. And we do have that automatic 365-day run out. If the transplant happens during our period and the group does not renew, we do continue to cover that patient. Okay, how this product is underwritten. We allow what we call a minimum of 50 employees for pooled TPAs, and then we offer 150 employees for a preferred producer. We know that it is impossible to underwrite to all these small groups, so we came up with a strategy where we partnered with TPAs. Cypress is one of our premier pooling partners, and we are certainly glad they are. So we allow them to market our product and take lives down to 50 employees. If you are what we considered a preferred producer, you are coming to us as a broker or a consultant or another TPA. The difference for you is you are not going to have the same rates that Cypress is going to have. We will rate you differently. You're going to be at 2.5% higher. Why would you not use Cypress? Better rates. The rates are going to vary per state. We stratified this with our actuarials. They did the population and frequency coupled with our provider contracts to come up with these rates. The rates are going to be the rates per state. You do have minimal underwriting at inception, no underwriting on renewals for pooled or select groups. A select group is also going to be one coming through a producer that when you fill out the application has no pre-existing on it. That's what we would consider a select group. Rates still are different for a select group. We do impose a PreX on this product. I'll get to that in just a moment to explain how that works. And our policy is written on National Union Fire paper. It's A-rated by AM Best. Okay, here is the PreX. I know it scares some of you. However, with transplants, you're jumping over stop-loss contract years. You'll blow through that first 12 months with no problems before anything happens. And it goes like this. In the past 24 months, has anyone had a transplant? Has been recommended for a transplant? Been evaluated for a transplant? Has been diagnosed with chronic kidney disease, end-stage renal failure, or on dialysis, are already listed for a transplant. Those are the only 5 conditions that we will be looking at. If they come in for something else, it will not happen. We'll pay that claim. It is only these 5 conditions that we would PreX. We're not looking at 100 different trigger codes for this. And again, we do have an out-of-network that we pay up to a scheduled amount in our policy of 80%. However, the balance billing on that does not go back to the plan. The patients are on the hook for that if they go out of network. I will tell you in the 9 years, we've never had anyone go out of network. Because we're in front of this, we steer them into our centers. so it usually doesn't happen. Okay, other avenues. Again, when we do the pooling partners, we ask that they agree to bring in at least 5,000 employee lives over the first year. Sometimes we understand that's a little difficult to do. We let it slide. We'll give you 2 years if you need to bring that in. You must be an approved TPA through AIG. You must agree to follow our implementation guidelines. The reason we want to partner with TPAs is because the way our case management is structured, it's very unique for this program. We are working very closely with the TPA and with that patient. They are our eyes and ears, the TPAs. They are referring these patients into us. They're the important piece to how this works. So that's why it's very good to work with our TPAs to get these patients referred in. We do ask that they actively promote our OT program on all new groups and all renewals. We also ask that they maintain a balance in their block of business. We totally understand that this product is easy to sell to an 80-life group who has a pending transplant. But why would you do that? I know that they would say, thank goodness somebody is here to insure my burning building, but that's not what we want you to do. The advantages to this is any group life of 50 employees or over, no underwriting at renewals. Rate increases that we've had over the years are based on trend only, medical trend, no experience. We're not looking at the activity in that group at all. And we also give you access to our website. We have the organ transplant website, and we give Cypress access passwords to get into that. They can go in there at any time and customize a quote for any of their clients. It is a unique tool that not everyone has it, just our pooling partners, and they can create it, and the quoting module will spit out one of those value props, and you can just give it to your client and explain how it works. Okay, here's other avenues that you can take to get into this. Preferred producer, if you come to us, you must have a minimum group size of 150 employee lives. You must be an approved broker or consultant, or if you're using a different TPA, it has to be approved by AIG Benefit Solutions. The advantages are groups deemed as select is going to have preferred rates. Again, your rates are not going to be the same. And no underwriting at renewal, and again, the increases are only due to trend. And if a group comes to us and is deemed as non-select, that would be a 150 life group that is coming in with a PreX. If it is allowed through the underwriter, it is underwritten all the time. Every year they would look at that. And then the rates, exposures will be capped at 20% of the expected claims cost. Okay, and this is a value proposition. This is what we create for our groups so that they can show this to their clients to explain to them how the program works and how it can be a savings to them. Keep in mind that this value is on one individual in the group. That is it. You could have 2 or 3 in your group. Okay? Here you're going to see we have a 250 employee life group. And we're going to show you with this example, they have a spec deductible of $50,000. We're going to show you their estimated stop-loss premium of $200,000. We know that's a moving target, but it's a nice round number, and we wanted to use it for the sample. And if you add our transplant premium to this, it would be $28,000. Now, when we have presented this to clients, there's 2 pushbacks we normally get from this. One of them is, we have stop-loss. Why do we need a transplant carve-out? Well, the few slides previously before you saw, statistics tell you your stop-loss carrier probably isn't going to cover you due to those stop-loss contract years jumping over, exposures, and their lasering. So what happens here is, when this group has a transplant, they have to internally fund it through that spec deductible. That is the agreement they have with their stop-loss carrier. The group thinks that, well, I'm indemnified, I'm going to be fine, I just have to pay that $50,000. So let's show what the PEPM would be for this. When that group would have to fund it, they're going to fund 250 employees, lives divided by $50,000 in deductible, spec deductible, divided by 12 months. So the PEPM on this is going to be $16.66. Now, if you had our transplant premium in place, our PEPM for this would be, again, $28,000 divided by 250 employee lives, divided by 12 months, would be only $9.33 PEPM. Even at this level, it's still a good value. Okay, but the reality of a stop-loss world is you probably are not going to be looking at just a $50,000 spec. You're going to be looking at a $250,000 laser on that individual. So let's do the PEPM on that. You take the $250,000 divided by 250 employees divided by 12 months, you're now looking at $83.33 PEPM. But if they have our program in place, you're not looking at that spec deductible any longer. It's a first dollar fully insured product. You're not looking at that $250,000 laser either. You're just looking at that premium that you're going to pay. So if you have our program in place, and when you do, in this example, we would give you 7% off of the stop-loss rates for carving this out. You're insuring it under a different product, so the stop-loss carrier is not on risk. 7% off of these rates would be $14,000. So instead of paying the premium of the $200,000, you're going to take off that $14,000 from your stop-loss premium. You want to take that savings and apply it to your transplant premium. So actually, you're only going to pay $14,000 for having the organ transplant. You want to take that savings and apply it because that's what's driving your savings is this program. So actually, you're only looking at the PEPM of $4.60 for having this program in place. Now, that's a much better value than paying $83.33 PEPM. Okay, the second pushback that we get, we are a small group. We've never had a transplant. Well, again, we understand a transplant can happen at any time, regardless of your group size. So we're going to show you if it happened in the first year. You're only going to pay 1 year of premium, and that's that discounted premium because you're getting that from your stop-loss carrier. You would have only paid, your savings is going to be $236,000. You've only paid $14,000 in premium. Let's say if it doesn't happen till the second year, that's 2 years of premium you've paid. Your savings would be $222,000 on that. And if it doesn't happen till the third year, 3 years of premiums, your savings is going to be $208,000. And if we continue to do this until it becomes a negative financial value, it would take this group 18 years to go without a transplant before this would be a negative financial value. And we all know that's a virtual impossibility in this day and age with medical technology. Do we have anyone in the group that has our organ transplant policy in place right now? Have you had good luck with it? Have you had any experience? Wonderful. Great. Okay. Great. Thank you.